Ladies and gentlemen, welcome back. Today is Wednesday, December 17th, 2025, and if you are watching this, you are witnessing history. Absolute, undeniable history. For decades, literally decades, we have heard the whispers, we've read the forums, we've seen the conspiracy theories. The idea that the silver market was rigged, that the price was being artificially suppressed by a cabal of bullion banks using paper contracts to crush the physical reality, they told us it was nonsense. They told us supply and demand was working fine. Well, look at the charts today. Look at what is happening right now. Spot silver has just blasted past $66 an ounce. We are trading between $65.76 and $66.59, depending on your feed. That is a daily gain of over 3%. But zoom out. That is a 127% increase year to date. This isn't just a rally. This isn't just a bull market. This is a breakdown of the old system. The dam is breaking. The suppression scheme that has allegedly held this metal down since the 1980s appears to be crumbling before our very eyes. In this video, we are going deep. We are going to look at the smoking gun data that just dropped from the CFTC showing what the banks are actually doing with their short positions. We're going to talk about the drain on the COMEX, where over 90 million ounces have vanished since October. We're going to explain the terrifying spike in lease rates that signaled a physical emergency in London. And we're going to discuss the rumors, yes, the rumors, of a massive margin call that might have triggered this latest vertical move. Buckle up. If you hold silver, if you hold miners, or if you're just wondering if it's too late to get in, you need to hear this. Let's talk about momentum. In financial markets, things usually move in waves. 2 steps forward, 1 step back. But what we are seeing in silver right now is something different. It's called a parabolic acceleration. Look at the time intervals. It took silver 145 days to grind from $20 to $30. It took another 145 days to get to $40. Then the engine started revving. It went from $40 to $50 in 39 days. And then from $50 to $60, it took 12 days. 12 days to move $10. And today we are pushing past $66. This is what happens when a market runs out of physical supply. This is what happens when the sellers just disappear. Experts are telling us to throw technical analysis out the window. You can't use moving averages or RSI when a market enters a vacuum phase. This is pure, unadulterated price discovery in a market that has been starved for years. And let's be clear, silver is leaving gold in the dust. The gold to silver ratio, which historically sits around 50 to 1 and was blown out to over 80 to 1 recently, is crashing down. We are seeing silver act not just as a precious metal, but as a strategic industrial asset that the world suddenly realized it doesn't have enough of. But why now? Why December 2025? To understand that, we have to look at the darker side of this market. We have to talk about the suppression. For years, the argument has been simple. Bullion banks, the big players on Wall Street and in London, would use the futures market, the COMEX, to sell massive amounts of paper silver that didn't exist. They would dump these contracts during periods of low liquidity to smash the price down, triggering stop losses and scaring retail investors away. Critics called it manipulation. Regulators called it market making. But the theory always had a caveat. This manipulation only works as long as there is enough physical silver to satisfy the people who actually want delivery. If too many people stand for delivery, if they say, I don't want cash, I want the metal, the game ends, the paper shorts get squeezed. And that is exactly what we are seeing in late 2025. The physical market is screaming. We have deficits projected at over 200 million ounces for the 5th year in a row. You have industrial demand from solar and EVs eating up over 60% of the supply. And that silver is gone forever. It's not like gold, which sits in a vault. Silver gets used, consumed, and thrown into landfills. But the real game changer, it's who is buying now. We have reports, some confirmed, some leaking out, of central banks entering the silver market. Russia's budget for 2025-2027 allocates over $535 million for precious metals, and sources say a significant chunk is silver. India imported 1,600 tons in November alone. When nations start buying strategic reserves, they don't buy paper contracts. They buy bars. They take them out of London, out of New York, and they put them in their own vaults. This brings us to the most critical data point of the month. The one the mainstream media is ignoring, but the one that proves the stress in the system. Lease rates. This is the cost to borrow physical silver. In a normal, healthy market, lease rates are boring. They sit at 0, 3% or 0, 5%. In October 2025, the silver lease rate in London spiked to nearly 40%. Let me repeat that, 40%. Do you understand what that means? It means there was essentially no silver available. If you were a refiner or a mint and you needed silver to fulfill an order, you had to pay an annualized rate of 40% just to get your hands on it. This was the great silver squeeze of October. We heard reports of the London market effectively freezing. A massive order came in from India, and the metal wasn't there. There were rumors of emergency airlifts, planes loaded with silver flying from stockpiles to vaults just to prevent a default. Rates have since cooled down to about 5% to 8%, which is still historically high. But that spike was the warning shot. It told us that the float, the available inventory, is gone. We are scraping the bottom of the barrel. And if you think London is tight, let's look at the COMEX in New York. This is the battleground for the price. Inventory data is bleeding out. Since October 1st, over 92 million ounces of silver have been drained from COMEX vaults. In early December alone, we saw 47, 6 million ounces delivered. That is over 60% of the eligible stock moving. This isn't traders flipping contracts for a profit. This is entities taking the metal and leaving. And here's the smoking gun I promised you. The bank participation report from the CFTC. For years, the Big Four or Big Eight banks held massive short positions. They were the ones betting against the price. But look at the December data. The net short positions of the major U.S. banks are at historic lows. They have been covering. They have been buying back those shorts for months. Why? Because they know what's coming. They know the gig is up. If they were still short right now with the price hitting $66, they would be insolvent. The fact that they have reduced their exposure tells you that the capping incentive is gone. They aren't trying to hold the beach ball underwater anymore because they know it's about to launch into space. Now, I want to address the elephant in the room, the rumors. Social media is on fire right now with reports of a massive margin call. There are unverified rumors circulating that a major financial institution, not necessarily a bank, maybe a hedge fund or a trading house, got caught on the wrong side of this move. The story goes that this entity was short, the price moved against them, and they got a call from the exchange, post collateral or we liquidate you. They couldn't post, and the computers took over, buying back silver at any price. Some are pointing to a $2.50 vertical spike we saw intraday as evidence of this forced liquidation. I have to be responsible here. We have no official confirmation of this from the CME or the CFTC. No bank has declared bankruptcy yet. But where there is smoke, there is usually fire, and we do have other signs of stress. There is talk of the Fed's overnight repo facility seeing unusual activity, up to $50 billion in liquidity needs. Is someone bailing out a player who got crushed by silver? We don't know. But in 2025, after everything we've seen, would it surprise you? Let's look east for a moment. If you want to know the real price of silver, don't look at New York. Look at Shanghai. China is trading at a massive premium. While we are celebrating $66 here, the Shanghai Gold Exchange has seen silver hitting equivalent prices of $67.43 and higher. The premium is around 4% over the London price. This is creating an arbitrage opportunity, but the metal can't move fast enough to close the gap. Why is China paying more? Because they are hoarding. Industrial users in China, the solar panel manufacturers, the electronics giants, are terrified of tariffs and supply chains breaking down. They are front-running the shortage. They are buying 6 to 9 months of supply now because they think they won't be able to get it in 2026. This is the unobtainium era. When a commodity becomes scarce, price stops mattering. Availability is the only thing that counts. We have to remember the fundamental driver here. It's not just speculation, it's physics. We are in the 5th consecutive year of a structural deficit. The world mines about 800 to 900 million ounces a year, but we consume over 2 billion. That gap has been filled by above-ground stockpiles, investment bars, old silverware, melted coins. But those stockpiles are finite, and when they are gone, they are gone. The Silver Institute is projecting another 200 million ounce deficit for this year. And with the explosion in AI technology, which requires silver for high-end contacts and chips, the industrial demand isn't slowing down, it's accelerating. So where does this leave the miners? If silver is at $66, the mining companies must be printing money, right? This is the opportunity for the investors watching this channel. Look at First Majestic Silver, ticker symbol AG. The stock has hit a 52-week high of around $60. 57. That's a 152% gain year to date. Fantastic returns. But wait, silver is up 127%. Usually miners provide leverage to the spot price. They should be up 200%, 300%. The fact that the miners are lagging behind the physical metal is a massive anomaly. It suggests that the equity market hasn't fully bought into this rally yet. They are scared of a pullback. They are worried about costs. But let's look at the numbers for First Majestic. Their earnings estimates for 2025 are showing 279% growth. At $30 silver, they were doing okay. At $66 silver, their margins are exploding. Every dollar increase in the price of silver goes almost straight to their bottom line. If this price holds, Or if it goes to $70 or $100 like some are predicting, these stocks have a lot of catching up to do. We could be looking at a catch-up boom where the miners suddenly double in value as Wall Street wakes up to their cash flows. However, we have to be balanced. We aren't just here to pump. We have to look at the risks. The RSI on the monthly chart is screaming overbought. We have gone vertical. In any normal market, you would expect a pullback, a retest of the breakout levels. Maybe we drop back to $60 or even $55 to shake out the weak hands. And there are economic headwinds. If the U.S. economy enters a hard recession in 2026, industrial demand could dip. Some analysts are predicting a 2% drop in industrial offtake if things get ugly. But here is the counter-argument. Even if demand drops 2%, we are still in a massive deficit. A small recession doesn't fix a 200 million ounce shortfall. Let's talk about the psychological aspect of $66 silver. For a long time, the all-time high of $50 hit in 1980 and 2011 was the ceiling. It was the psychological barrier. We smashed that weeks ago. We are now in uncharted territory. There is no resistance on the chart because we have never been here before. This is price discovery mode. The targets for 2026 are shifting rapidly. Analysts who were saying $50 by year end are now scrambling to update their models. We are seeing calls for $70, $80, even $100 silver in 2026. Why $100? Because that's where the gold to silver ratio starts to make sense again. If gold is at $3,500 or $4,000, and we go back to a historic 40.1 or 30.1 ratio, triple-digit silver isn't a fantasy, it's math. So, is the suppression scheme finally crumbling? The evidence suggests yes. The tools they used to use, the naked shorts, the lease rate manipulation, are breaking because the physical metal isn't there to back them up. You can't suppress the price of something you don't have. When the lease rates hit 39%, that was the system screaming for help. When the banks covered their shorts to historic lows, that was the insiders exiting the building before it burned down. We are watching a paradigm shift. The paper market, the COMEX, the LBMA, has dictated the price for 40 years. Now, the physical market, Shanghai, Mumbai, the solar factories, is taking the wheel. I want to leave you with this thought. If you own physical silver, hold it tight. The volatility is going to be insane. We might see $5 drops in a single day. But the trend is undeniable. If you are looking at miners, do your due diligence. Companies like First Majestic are positioned to win, but operational execution matters. And if you are still on the sidelines, well, you have to ask yourself, do you believe the deficit is real? Do you believe the banks are really stepping back? Because if you do, $66 might just be the beginning. Let me know in the comments. Are we going to $100 in 2026, or is this a blow-off top waiting to crash? And what do you make of those margin call rumors? I want to hear your theories. Don't forget to like this video. It helps us get this truth out to more people. Subscribe and hit the bell because this market is moving fast, and you don't want to miss the next update. We at Currency Archive want to thank you for being part of this movement. Stay safe, stay stacked, and I'll see you in the next one.